Good afternoon and welcome to our special offering, Know Your Debt Fund, where we analyze the various categories of debt funds so that you, our investor, can understand the debt portion of your portfolio better and can also navigate through what is sometimes considered the complex world of debt funds and the various schemes that are present. So today we're going to talk about the corporate bond fund, and this is a category which actually has assets of about 86,000 crores plus as of the 30th of April, and in the last 13 months from March of last year, the category has actually grown by 51%. So what is it that investors are finding so attractive, and how does it really stack up in terms of a presence in your portfolio? So joining in to answer all these questions today, we have Prableen Bajpai, the founder of FinFix Research and Analytics. Hi Prableen, good afternoon, and thanks much for joining in. To begin with, I want to actually find out what the corporate bond fund really does, because a lot of investors, I imagine, could also get confused between a corporate bond fund and a credit risk fund. So, how does each work and what is the difference?
All right. Hi, Smira. Thanks for having me. I think to begin with, I'd like to say that something that investors in the debt fund categories, need to remember is that credit risk is embedded, in some form or the other across all debt funds. So whether we are talking about a corporate bond fund or a credit risk fund or an ultra short-term, bond fund, every fund would have some element of credit risk to it. Having said that, SEBI has, identified and laid out the investment universe for these two categories if we talk about the corporate bond and the credit risk. A corporate bond fund has the mandate to invest 80%. It has to invest 80%. It can go higher to that in the highest rated instruments which are there in the market, in terms of AAA, AA plus. And a credit risk fund has to invest up to 65%. It can go beyond that in instruments which are AA and below. So, I'd just like to draw an analogy here for our viewers that just the way in the large cap fund that we invest in the equity markets, the investment universe is defined that a large cap fund would invest, a minimum of 80% or more in the large cap stocks, which are the 100th stock on the exchange in terms of market capitalization. Likewise, a corporate bond fund, can be considered as the counterpart in the debt space, where 80% of its holdings have to be in the higher credit rated, papers. And if we have to compare a credit risk fund, I would, take it to the mid cap or the small cap segment, where about 65% has to be in the mid cap and the small cap space. So by the very definition and the way these funds are structured, the risk is higher in a small cap and a mid cap. Likewise, it's much higher in a credit risk fund vis-a-vis a corporate bond fund. A few more points, how these funds differ. Typically, a corporate bond fund, we'll see that there are no entry and exit loads, and that also the expense ratios are lower vis-a-vis a credit risk fund. Another important point here is the investor profile that we have for these two funds. So typically for a corporate bond fund, we've seen more of institutional corporate clientele, while in a credit risk fund, there is more of the retail segment which is there.
Prableen, that's an interesting point that, if by and large there are institutional investors who've been using the corporate bond fund space, does it even make sense for a retail investor? I mean, is there a reason that traditionally retail investors have not used this space?
Okay, so that's slightly tricky to say. See, the expense ratios here are lesser, so it also links to a few other things in terms of how well a product is pushed. So I don't want to go to that part. But having said that, when corporates or institutions are investing, there's a little bit of risk there when there are no exit loads, because the stickiness of the money can be much lesser. And the institutions, are savvy investors. They know when to exit. There can be one tendency of, some kind of hot money as well coming into these funds. So that is something, a retail investor has to watch out for.
Okay, fair enough.
And, another point
so
here
now
is
if somebody is holding a... Go ahead, Prableen. Okay, so basically what we have learned so far about the corporate bond fund is that a minimum of 80% of the investments have to be held in AA and above paper, while in the credit risk category the distinction is defined by SEBI is that a minimum of 65% has to be held in AA and below. So on one side you have a fund where the mandate is that the threshold is only upwards instead of in terms of superior credit ratings of the underlying, and in the other the distinction is in terms of AA and below being a minimum of 65%. Prableen, you were talking a bit more about why we have seen more institutional investors in the corporate bond space.
So typically, Sumaira, I have some data which talks about what kind of defaults have we had in the past. So a report by one of the credit rating agencies, it talks about that during the years 2007 to 2017, there was just about 0.12% default in the AA segment. On a 3-year basis, and the single A was 0.9% on a 1-year basis and 3.91% on a 3-year basis. So, the way the economics has worked in the past, moving into the segment of AA and lower has actually worked well for fund managers or funds which have been operating them. And it is the current, economic, these unprecedented times obviously cannot justify that why you're holding so much in papers which are not very liquid, but it also accentuates the problem of selling lower quality papers. So, it's worked well because these papers, the lower rated papers, typically give you more returns. And that's something probably that has enticed investors, in the past to be a part of this space.
Okay, so with that, let me ask you my next question, because, in the Franklin Corporate Bond Fund also, we've seen that there is a tendency to go lower down the order, right? So if somebody is holding, say, either Franklin or some other corporate bond fund, how do they analyze their fund? What should they look for?
Okay, so I think whenever we are we're talking about, holding a certain fund, the first point is that you should know what you are holding. And in a debt fund, it becomes different because you're actually lending out your money in, through a mutual fund. So you should know who, where is your money being lent out to, who are the entities where your money is going. The bigger the names, the more credible the names, there is a higher and a fair chance of your money coming back. So that is the segment where you look at the credit rating, on the which is available on the fund fact sheet, that how much is being invested into the highest rated bonds, or how much is backed, by the government, how much is sovereign, and beyond that 80%, which fund is actually moving beyond that 80% and taking that extra risk by investing that 20% in comparatively lesser rated, papers. So typically the top 5 funds, which we've had in the category in terms of AUM, have about 95%, averaging about 95% of their assets in AAA, equivalent and sovereign space. And, Franklin, because if we pull up, its fact sheet, as on March 31st, because the latest fact sheet is not out, they were holding about 83%. So they definitely have filled the mandate, and they have about 10% in the AA segment. So there's that little extra risk where they are taking, they're moving into the AA segment. And this is reflective in the, the yields to maturity that these funds have. Quickly explain the yield to maturity for our viewers. So yield to maturity is the returns that you can expect, from a fund if all the underlying portfolios are basically held till maturity. So that's the kind of return expectation you can have from it. So for Franklin, it definitely goes into the 7.8 kind of a percent, vis-a-vis, the top 5 funds that we have in terms of AUM, they're hovering around 6.5 to 6.8.
Prableen, I was intrigued that you also chose to, add the L&T AAA's bond fund in this, because that is entirely holding sovereign paper, right?
So that is where I want to bring up the interest rate risk, Sumaira. So when we're looking at, this, because currently there's so much hue and cry about the ratings. So probably, we would want to focus on what the ratings of the credit papers is. So L&T, it's amazing with a 91%, in sovereign and AAA. It's a very, very, clean portfolio. And they have a YTM of 7.16%. So a paper which is holding, completely AAA and sovereign holdings, how can it have a YTM of, let's say, 7.16, which is higher than what the other funds are giving in the space? And that is because the average maturity of these papers is way higher than the average maturity of the category or these funds which we've mentioned above. So, it's got an average duration of about, average maturity of about 8 years and a modified duration of about 5 years. And, whenever we are we are buying a paper which is for the longer term, the interest rate risk in it is higher. To just explain this quickly, let's say, I have bought, somebody has bought it at 6%. And sorry, you've lent out at 6%, and the interest rates in the markets are now at 8%. You would want to get rid of that paper, which is now just giving you 6%, and you would want to lock yourself in a paper which is giving you 8%. So that's the interest rate risk this fund is undertaking, and that is why it's got a higher, yield to maturity again. So duration, a risk, which is the interest rate risk, as well as the credit risk, both need to be checked while you're selecting your fund.
Yeah, and the interesting point to be noted here is that, regarding the SEBI definition, they have only spoken about what is the rating of the underlying. There's no, mandate as regards what should be the duration of the underlying, and therefore that becomes completely at the discretion of the fund manager. Prableen, stay on with us. We'll take a quick break, come right back. On the other side, we'll tell you about what are the warning signs you should watch out for in your corporate bond fund and whether or not it is suitable for your portfolio. Do stay tuned in. Hi, welcome back. You're watching our special offering, Know Your Debt Fund, and with me this afternoon is Prableen Bajpai of FinFix Research and Analytics, and we're talking about the corporate bond funds and how retail investors should view them and whether or not there is a place for them in the retail portfolio as well. So we've spoken a bit about what the fund itself is, the category does, and how it's different from credit risk. Now we want to talk about what are the warning signs. So if anybody is holding a corporate bond fund at the moment, Prableen, what are the warning signs that they should look out for in the future?
So Sumaira, I'll just like to point out 5 things here quickly. And the information, this information is very easily available either on the fact sheets or any of the platforms like Value Research or Money Control, Morningstar. So the first one is the standard deviation, which basically is it's a measure to gauge the risk which is there in a fund. So if the standard deviation is way higher than the peers, so a good way is to always measure it against the the category average. So if it's way higher, I think that is the first sign you should look out for. In case of Edelweiss, which is one of the funds which is having a YTM of about 9.5%, the standard deviation is currently 7.86, vis-a-vis the category average of about 2.5. And the other 5 funds which we spoke about with the largest AUM currently have a standard deviation lesser than the category, which is about 1.5. So that's the first thing. Second, again, is the higher yield to maturity. So why are you going to earn anything extra? Why are you getting extra returns by investing into that fund is the question, where you have to identify whether you are undertaking higher credit risk or higher interest rate risk. The third point I like to mention is the depletion of AUM. So, of course, if the AUM, there are huge redemptions, you have to definitely go and find out why is the fund, why is there evaporation of money. And even if money has come in, there's a huge influx of money, I think that is, again, something which one should check. The third is the credit quality, where we want to see where our investments are, whether the 20% of the mandate, which is wherever you go kind of a mandate, how well is that being used? Is that being used in the AAA and sovereign category only, or are you going beyond that? And the final point here would be the duration. I would be happy if the duration, you stick with the category average of about 2.5 to 3 years, vis-a-vis few funds which have it way higher. So I think duration is also something that needs to be matched with the investment, horizon of the investor. So that's something they should look out for.
Okay, and just a note to our viewers, standard deviation, of course, is a measure of risk. It measures how much, that scheme differs from what is the mean for its category. But Prableen, what is the suitability of the corporate bond fund in a portfolio? I mean, if the assumption is that, yes, it does serve a purpose, what is that purpose? I mean, what does it bring to the table?
So I feel, Sumaira, the corporate bond category is probably underutilized because, see, just by its mandate, it filters out the quality of the rating, the papers that you can hold. So you can be rest assured that 80% of your holdings are in higher rated instruments. And what is your ask from a debt fund? It's usually that it has to be, it's safe, there's liquidity, and there's transparency, and there's tax efficiency. So this corporate bond category, I think, fits into it very well. And one thing I like to mention here is that the AAA market, or the higher rated bond market in India, is the only segment where you can actually find price discovery, and the lower segments do struggle with illiquidity. So why not have your money in a segment where the papers can be sold, there's price discovery, and I think that's a good place for investors to be.
Okay, and Prableen, in this we've seen that there are some funds which have an AUM of just about 1,000 crores, and then there are the leaders in the category which have 17,000 crores, if not more, each. So does AUM matter when you're selecting one of these schemes?
So Sumaira, when we're talking about the AUM, I'll just quickly cite the example of IDFC credit risk and ICICI credit risk. The AUM of ICICI credit risk is about 11 to 12,000 crores, and that of IDFC is just about 1,000 to 1,500 crores. But I think both of them have really fared well. They've come out pretty neat from the crisis that has been there in the market, previously, at least till now. And so AUM cannot be the only yardstick. It definitely plays a role because no one would be comfortable, investing in a fund which has a very, very thin AUM. Having said that, even a very large AUM can have its disadvantages in terms of being stuck with the wrong paper and then, trying to sell it off. So the proportion, even a 5% of a 10,000 crore AUM is very huge. And sometimes the markets may not have that kind of a depth to absorb it. So I think it's got its own pros and cons, but
where does an investor actually look to invest? I mean, sure enough, corporate bonds have a place in a retail investor's portfolio, but how do they navigate the debt space entirely? Where can they invest?
So I think, Samira, one thing, the first thing for an investor, to know is that if you're entering the debt space, you're not really entering it to make, supernormal returns. You are looking for something better than what a fixed income product otherwise can give you with better tax efficiency and the other advantages of convenience. So I think it's very important to restrict two kinds of risk, which is your credit risk as well as your interest rate risk. So, managing these two risks is essentially what can get you a good portfolio in the debt space. So your core basket of investing in the debt products can be, something in today's times when interest rates are low and, there is so much uncertainty with regards to how the economy is going to move forward. It's really important to avoid, I think, anything in the lower rated category and stick to comparatively lower durations. So this way your credit risk as well as your duration risk is broadly managed.
All right, Prableen, thanks very much for joining in and for explaining this concept so beautifully. Thanks a lot. So we hoped you learned a little bit about the corporate bond fund space. And, all of these categories in them are very, very large. So I do promise that at some point in the future, we'll come back and talk a little bit more about the intricacies that we may have missed today. But thanks very much for watching. Hope you've learned something and do stay tuned to CNBC-TV18.